Now, I've seen and read a lot over the Elliott Wave principle, but I've very rarely seen it very practically applied onto a market or an index. Now, to see if I could really apply this in the marketplace to see how the market actually moves, I have plotted Elliott waves on the S&P 500 from 1983 to 2009. The chart is a logarithmic scale chart, which you'll see later. And you can see here the purple line here is the actual S&P 500. And the black lines are how I envisage the Elliott waves, the impulse waves, corrective waves, and the lettered phases. So what's important to note as we would drill down and look at this, not on a view of almost 30 years, but on a yearly view or a 10-year view, for example, these waves would multiply as you zoom in. So this is a very high-level view, a long-term view of how to apply Elliott Wave Theory to the market. So here we can see from 1983, we begin with the first impulse wave. So we have first impulse wave 1. Here, 1. And then we have 2, 3, a small pullback here, 4, correction, and then 5 to finally complete the first part of the wave. And then, of course, we saw in 1987 the rather large correction, which we can see here, A, B, and then C. And then we move on throughout the late 80s to another primary move. This is the second leg of the primary bull market, and this was an absolutely huge bull market when we look at it from this perspective. So first leg of the bull market completed with pullbacks. So now we're on to the second Elliott wave. So 1, 2, 3, 4, 5 here with the ABC correction. Now the third leg of the bull market, leading from the mid through to the mid 90s through to 2000 with 1, 2, 3, 4, 5. And now you can see here, this is essentially the peak of the 2000 dot-com bubble, and that would constitute essentially an entire huge bull market move. Now, as you drill down into that, you may see the 4-year business cycle, for example, very clearly within this. You can see this here, potentially here and here and here, and you can see then an extended rally really throughout the late 90s. So once we've seen that, then we've hit the peak right here of the bull market in 2000, and then you can see the overall lettered phase beginning here, A, B, C. And if we drilled into that, and here you can see a zoom on this. As we zoom in on this corrective wave here, we would actually see on the grand scale it may be a corrective wave, but as we look in there we can see the primary impulses down. So you can see the zoom in here, the 1, 2, 3, 4, 5, a small correction here, A, B, C, and then another impulse wave, 1, 2, 3, 4, 5, signaling the bottom of the 2003 bear market right here. Then we start a primary up move again. At the time, 1, 2, 3, 4, 5, and then your A, B, C in 2009, ready for the next startup of the next bull market. So you can see how exactly the patterns do reverse on the way down. And this zoom in here, I think, clearly demonstrates that. It does take some time to get used to this. My advice would be to practice, try and visualize the entire move. So here you can see an entire move here. And then from here, the 8 waves, and this is obviously on very zoomed out long-term perspective, and here, for example, and then we have another full wave here, and then again there. There is also something called the Rule of Alternation. The Rule of Alternation suggests that no two waves will be of the same length or pattern twice in a row, which makes it especially wonderful to try and evaluate what exactly constitutes a perfect Elliott wave. But let me try and demonstrate the Rule of Alternation. So from 1984 to 1987, we saw a very strong bull move. And from 1987 to 1989, we saw a pretty sharp correction during certainly 1987. And then 1989 to 1994, essentially 1989 to 1994, we saw a shallower bull market, nevertheless quite strong. And then in 1994 to 1995, we saw a very, very shallow correction. From 95 to 2000, we saw an absolutely roaring bull market. And then from 2000 to 2003, we saw a huge 3-year correction. You can see how strong that was. A primary down move, essentially. And then from 2003 to 2007, we saw a long, slow advance. And then 2007, 2008, we've seen an absolutely aggressive and rapid, huge correction. So the Rule of Alternation suggests that no two will be the same each time. And here you can see there's a steep bull move, followed by a steep bear move, and then a slightly shallower bull move, followed by a shallow bear move, and then a very steep and aggressive bull move, followed by a steep pullback. And then we have a shallow bull move, and then a very aggressive pullback here. One point to note about Elliott Wave. If you would ask 3 Elliott Wave practitioners to map the wave onto charts, I'm sure they would do it 3 different ways. This was my attempt. The key to understand how patterns occurs is to try it for yourself until you fully understand it. One drawback of Elliott Wave is that it is only most clearly mapped after the event